Okay, let's get into this. Tax time for rental properties, right? It can feel like a bit of a maze.
Yeah, definitely.
So today we're doing a deep dive into the Australian Taxation Office's Rental Properties Guide for 2025. Think of it as the map for that maze.
Exactly. It's the official word from the ATO.
And our mission is basically to pull out the most important bits for you, the property owner, make it, less intimidating.
It's a dense guide, but it really lays out the ATO's expectations on income, expenses, the works.
Right. So first up, income. What do you actually need to declare?
Well, the guide's super clear here. You've got to declare the full amount of rent you get, period.
And other payments too, like bond money.
Absolutely. If you keep bond money because a tenant defaults or, say, an insurance payout for lost rent, that's all income you declare.
Okay, got it. Now, what about co-ownership? That seems to trip people up.
Ah, yes. This is where it gets, really interesting. If you co-own, say, joint tenants or tenants in common.
Which is most people, probably.
Yeah, very common. The ATO generally says income and expenses are split based on your legal interest, your ownership percentage on the title deed.
So wait, even if I pay like 70% of the mortgage and bills, but we own 50-50, it's still 50-50 for tax.
That's exactly what the guide says. Your private arrangement doesn't usually change the tax split based on legal ownership.
Huh. Is there any exception?
Well, the main one mentioned is if you're actually running a rental property business.
Mm-hmm.
But that's a high bar.
Right, not just having one or two investment properties. That's more like being an investor.
Precisely. A business usually means significant scale, activity.
Yeah.
It's much more involved.
Okay, clear. Let's switch gears to expenses. The guide breaks these down, right?
Yeah. What you can claim straight away, what you claim over a few years, and importantly, what you just can't claim.
Okay, what's a big one to watch out for straight off the bat?
The ABN thing. Seriously, if you pay a contractor for repairs or whatever, check they give you an Australian business number.
Why is that so critical?
Because if they don't, the guide states you might have to withhold 47% of the payment and send it straight to the ATO.
Ouch. 47%.
Yeah. And if you don't do that withholding correctly, you could lose the deduction for that entire expense. Imagine that on a big repair bill.
Okay, duly noted. Check the ABN. What about the common stuff we can claim immediately?
Your usual suspects. Council rates, landlord insurance, property agent fees, interest on the loan. Many repairs, too.
But not all repairs. What can't we claim, or at least not right away?
Okay, big ones.
Yeah.
Expenses when the property wasn't actually genuinely available for rent.
Like blocking out your holiday house for your own use.
Exactly. Or setting crazy conditions like rent way above market or maybe no kids, no pets, when that's totally unreasonable for the area and stops you getting a tenant.
So if you use it privately, even for a bit.
You must apportion. You can only claim the portion of expenses related to when it was genuinely available for rent or actually rented.
Apportionment, right. So divide the costs based on days available versus days used privately.
That's the basic idea, yeah. And initial repairs, fixing stuff that was broken before you rented it out, often when you first buy it.
Ah, that's not a repair deduction.
Nope. The guide treats that as a capital cost, part of improving the asset, not an immediate write-off like fixing something that broke during a tenancy.
What else is capital, not immediately deductible?
Costs of buying or selling stamp duty on the purchase, conveyancing fees, buyer's agent fees, those usually adjust your cost base for capital gains tax later.
And travel. Can I claim driving down to check on the place?
Generally, no. Not for inspecting or maintaining a residential rental property unless, again, you're in that rare category of running a rental property business.
Okay, and vacant land holding costs.
Also generally not deductible, though there are some specific exceptions outlined in the guide.
Right. So let's talk about the costs claimed over time. Borrowing expenses first.
Yeah, things like loan setup fees, stamp duty on the mortgage if they're over $100 total, you generally spread that deduction over 5 years.
And apportionment applies there too, if the loan wasn't 100% for the rental.
Spot on. If part of the loan was for, say, your private car, you only deduct the rental-related portion of those borrowing costs.
Makes sense. Then there's depreciation, right? For the assets inside. Fixtures, fittings.
Yes, decline in value. But watch out for the rule change from 2017. For residential rentals bought after 1 July 2017, you generally can't claim depreciation on secondhand assets that were already in the property, like the stove or curtains that came with the house.
Oh, okay. But new stuff is fine. If I buy a new dishwasher.
New stuff you buy is generally fine to claim depreciation on. And small things, under $300, you might be able to deduct immediately.
Good distinction. And the big one, capital works, the building itself.
Exactly. Construction costs, major renovations, structural improvements, like a new fence or driveway.
How long do you claim those for?
It's typically over 25 or 40 years,
Mm-hmm.
depending on when the construction happened. There's also a new 4% rate for eligible new build-to-rent projects that kicked off after May 2023.
What if you buy an older place and just don't know the original construction costs?
You might need to get a report from a professional, like a quantity surveyor, to estimate those costs. The guide mentions this.
And claiming these deductions affects CGT later, right?
It does. The capital works deductions you claim reduce the cost base of your property. It stops you getting a double tax benefit, essentially.
Gotcha. And underpinning all of this, records, records, records.
Absolutely critical. Keep everything for 5 years, income statements, receipts, loan docs. The ATO needs proof.
So wrapping this up, what's the big takeaway? This stuff is detailed.
Really is. You need good records, and you need to understand these distinctions: repairs versus improvements, investor versus business, private use causing apportionment.
It's not just about claiming everything you spend.
Not at all. It's about claiming what you're entitled to correctly.
Okay, so here's something to chew on for you listening. Given all these rules, the apportionment for private use, non-deductible initial repairs, no travel claims for most, limits on secondhand assets, how might really getting your head around this guide actually change how you approach things? Could it influence, say, which property you buy next? Or how you manage it day to day? Maybe even make you rethink using that holiday place yourself.
Definitely food for thought. Understanding the tax side up front is just smart investing.
Well, that was our deep dive into the ATO's rental guide. We've, only scratched the surface really, but hopefully that gives you some valuable pointers.